This is our second installment in our applied series. This week we're going to stick with the concept of substitutes, and we saw substitutes last week, substitutes and complements, when we looked at internal combustion engine versus electric vehicles and the role that government intervention could play in changing consumer behavior, or what the free market can do with no government intervention. This week we're going to look at pork versus beef, and here there's no government intervention to think about. It is just purely a price mechanism. And so we can observe consumer behavior directly without any intervention, so we can interpret it much more cleanly. So we go to the grocery store and we can see the price of pork and beef, and we naturally expect that beef is going to be more expensive than pork. However, depending on the price discrepancy, we will choose either beef or pork. If the prices are very far apart, we tend to select pork versus beef because we argue that the extra price we would pay for beef is not really worth it. We can barbecue pork just as well, and we can do a lot of exciting stuff with that. If the price differential is not very far apart, well, we'll opt for beef. It's not that much more expensive over pork, and it is a better meat, so we'll grab beef. So there is a natural price mechanism that adjusts consumer behavior quite well. So we would expect that the price differential between pork and beef should have some mean reverting level. And we'll use futures contracts to determine if that's true. Rather than looking at the price of pork and beef that you find in the supermarket aisle, we're going to go way up the supply chain and look at the price of pork and beef while it's still on the animal walking around. So we're going to need two futures contracts here. We're going to use lean hogs. My ticker in my system for lean hogs is HE. Depending on what system you're using, whether it be Bloomberg or something else, you might have a different ticker symbol for it, but you're going to want to find lean hogs and live cattle, LE. Each of these is for 40,000 pounds, which makes it a nice trade against each other because we don't have to worry about, well, if I have 2 live cattle, I need 3 lean hogs to equal the same quantity that the other contract has. Each are for 40,000 pounds, so it's a 1-to-1 trade. Which is going to be nice. And we're going to set up a reversion to the mean trade using futures contracts. This requires 2 things. Number 1, we have to first identify what is the mean reverting level and what is the standard deviation of the prices that we observe over some period of time, and at what standard deviation from the mean do we put a trade in. So we have to determine how far away from the mean do we want to be before we put a trade in. We're going to let historical observation tell us when that makes sense, just by looking at probably the last 4 years of data. And we have to determine from the time that we would put on the trade, because these are futures contracts, they do expire, we have to find an expiration contract date. What contract do we trade once we see that there is a trade? So if it's January and we see that we're a certain number of standard deviations away from the mean, we certainly wouldn't use January or February contracts. We have to use something either September or November, December contracts. So we want to have an idea of, well, what was the average time to revert to the mean? So I'm going to walk you through this all the way from the beginning. We're going to look at the lean hogs futures contract and get to know how that operates. We're going to look at live cattle futures contract. I'll show you where to find the description of each of these and what the important stuff is. We'll look at where we can find historical data for free, because most of you don't have subscriptions to data services. So there are lots of sites out there that have it for free, but they're not just going to hand you the data in a format that you need. You're going to have to, try to manipulate the site a little bit and use a lot of cut and paste and use Excel to get it to clean it up as best you can. But I'll show you how to do that from beginning to end. So first things first, let's have a look at the lean hogs futures contract and the live cattle futures contract. All right, so I've just gone to CME Group. You can find that at cmegroup.com. I've got the live cattle futures contract specifications up. There's a drop-down menu here where you can find all of the contracts. We'll look at that in a second, but let's have a look at what we have. Contract unit, 40,000 pounds. And whenever you want to trade a contract, even if you think you understand it, it's worth at least going through and making sure that you're aware of everything. 40,000 pounds, it's the price quotation is cents per pound. So if we look at a quote and we see 120.025, that's 120 cents. That's not $120, it's 120 cents. The whole contract is quoted in cents. So even if it were $4, it would be quoted as 400 cents. We don't need to know the port. Here is the minimum price fluctuation, 0.00025. That's of $1. So it's a quarter, well, it's 2.5% of a cent. So if the price is 116, the next price increment would be 116.025. That increment amounts to $10 per contract because the price is quoted per pound and the contract is for 40,000 pounds. So every price increment is $10. There are 40 price increments per penny, which means every penny move on this contract amounts to $400, every penny. So if it goes from 116 cents to 117 cents, the contract increased in value by $400. There's the product code, CME on Globex, LE. The months of trading, settlement method, we don't need to know any of that stuff. If you keep scrolling down, you'll get to position limits. We really don't need to know that. Live cattle settlement procedures. We're not actually going to take settlement and delivery of live cattle. CME 101, if you click on that, it's got a lot of good information on there. Let's have a look at what that looks like. It goes through the whole contract. If you really want to dive deep into this and get to know more, it tells you this is all about live cattle futures, contract specification for all contract months prior to October 2018. It tells you each futures contract shall be for 60% choice, 40% select, yield grade 3 live steers, choice select. This is relates to the age of the cattle that you're delivering. Contract specifications for all futures contracts commencing with October 2018 and beyond. So there's going to be a change to the contract specification, so that's important to know. Trading specifications, trading units, price increments, daily price limits, that's important to know as well. We see that it's 3 cents per pound above or below the previous day's settlement. That means it'll be either limit up or limit down. So if today we close at 116 cents and news comes out that there's going to be a shortage of beef into the future, then tomorrow we would expect the price to be higher. The highest it can go is $1.19, and then it's referred to as limit up, and it cannot trade any higher than $1.19. Now most people think that when it's limit up, trading is stopped for the day. Trading can only resume on any price below $1.19, so it can still trade for the day. It just can only trade at a price below the limit up trade. So sometime during the day news can come out that says, hey, it's not going to be that bad, and the price can actually decrease from the $1.19. Trading would still continue. But once you're limit up, that's it. You can't go any higher than that, but you can go lower. And of course, limit down means if we closed at 116 yesterday, the lowest it could go today is 113. But remember, 1 penny is $400, so limit up is a $1,200 gain, limit down is a $1,200 loss. And once it's limit up, that's it. It might not be enough. The very next day, it might open limit up again, which means it can go from 116 to 119 to 122 to 125 very quickly. It's hard to get out of these contracts when they go limit up. You're kind of in there for the next day. So just be aware of where the limit up is. Daily price limits, and this does change as you get closer to expiration. Notice here it goes to 4.5 cents per pound in the event the daily price limits have been expanded pursuant to the provision set forth above. So there are instances where if you're limit up for a period of time, the exchange may increase what limit up or limit down can be to say, okay, well, the market, it can't work fast enough with these 3 cents limits, let's expand it. Or typically the few days before contract expiration, the limit up, limit down tends to expand as well, so that the market can find can get to where it needs to get to if it has to move to converge to the spot price. So I'm not going to go through all of these things, but this is where you can find it. Just goes on and on. If you really want to spend some time really diving deep into a particular contract, which I would recommend if you're going to be trading or are interested in a particular contract or in a particular commodity, you really do want to get to know everything about it. This is a great place to get to know everything about this. For price limit updates, this gives you just a quick chart on what are the daily price limits for a whole bunch of class of commodities. We could see lean hogs and live cattle down here. We can see the 3 cents. The second column is for calendar spreads. This means we have 2 futures contracts, so we can see 6 cents. That makes sense. If it's 3 cents per futures contract and we have a trade that combines 2, well then yeah, we're going to experience 6 cents. All right, let's get back to our task at hand. Okay, we're going to need some data so that we can look at the price spread between lean hogs and live cattle over a period of time. So the first decision we have to make is, well, over what period of time? How far back should we go? And on this one, I think even if you go back 10 years, 5 years, 4 years, I think you're going to find the same mean reverting level. Because even with inflation affects the price of everything, and as the price of beef increases, it'll pull the price of pork along with it. So you just have to pick a period of time that makes sense. I think going back maybe to the beginning of 2014 makes sense, because we can pick out some good data at the beginning of 2014. And then we'll just do from 2014 to now. So across the top here, you got to watch all of these menus that pop out. You'll see commodities, real-time commodities, metals, soft, meats, energy. So if you click on meats, you'll get something that looks like this. Here are the 3 meats in the U.S. You have feeder cattle, lean hogs, and live cattle. Feeder cattle are cattle that are typically under 800 pounds, and they're sold to cattle ranchers who then turn them into live cattle by fattening them up. And cattle usually can go from 800 pounds to 1,200 pounds, usually in a season. So if you bring them onto the farm in April or May, by September you can fatten them up to about 1,200 pounds. So you got to get 400 pounds on them, and then off you go to slaughter. So you'll buy your feeder cattle, and then you'll put weight on them to turn them into live cattle that are ready for auction. So we're not going to worry too much about feeder cattle. We're going to look at lean hogs and live cattle. So let's click on live cattle, and this is what you'll get. I think I mentioned I'm at investing.com. If I didn't, let me just take a moment and explain this. There's lots of places to get free data. I find this one here to be the cleanest one. It's easy to use. It's easy to get the data off of without it being too difficult. And the cut and paste into Excel is just a gift. It works really well. So go to investing.com, and of course, like I say, you have this row across the top, and you'll find the meats. You'll find live cattle. Here we are. Over here, you'll see historical data. Let's just click on that. And it just gives you about the last 20 or 25 trading days, and that's it. But you can set your own range. So we'll set from here 01, 2014 to 2018. Have I got that? Oh, 2104. That's why. Hang on. 2014. There we go. And then you just click apply. And there's your data for the last 4 years. Now, be careful here. There's a button that says download data, and you might think this is way too easy. It'll download it into a comma-separated file. However, it does require you to register. Registering is free. It's not a big deal, but if you don't like to leave footprints online with your email everywhere, don't click that button. And even if you do click that button, you're not going to get 4 years. What's going to happen is you have to do this and try to get as much on the screen. You click download data, and it'll only give you the data that's on the screen. So that's a bit of a pain to do. So what we're going to do is we're just going to put your mouse in the first column here, and we're just going to drag down. That's all. And we'll just drag down to, let's say, July 30th. Just to show you how easy this gets into Excel. And all we have to do is, if you have a Mac or a Windows, just copy it. On a Mac, it's just Command-C. And then we're going to go to Excel, and I'm going to show you how easy it is to paste. All right, so here's an empty Excel sheet, and we're going to paste. Never paste in the first column. I see people who want to go up here, and then they want to paste it to use all the cells. Never paste up there. Always move down. Let's go to A4, and we'll paste in there. Look at that. It drops it into every cell perfectly. We don't have to worry about doing any kind of work at all. So that's kind of why I like that site, is because the cut and paste drops it right into where I want it to be. How come we never use the top row of cells up there? You may want to put titles up there. And if you try to push everything to the very top, suddenly you're going to have to start inserting lines. And if you got everything formatted and all of the data in a format that you want, and it's lined up with more data on this side, you run the risk of messing up some things that you've done. So I feel it's always better to anticipate and say, look, I'm going to leave the top 3-4 rows all the time, just in case I want to put some stuff up there that I can easily reference. So I always start a little bit down. So there we go. Notice now it's from August 24th and it goes down to July 30th. That's going to be a little bit of an issue when we create a chart, because our chart is going to go from our most recent period of time to the oldest period of time, whereas when we're close to the origin on a chart, we want it to be the most historical period of time to the most recent. So we're going to have to sort this again. But first, let's go get just as much data. This is the live cattle. Let's go get just as much data for live hogs. I'll show you how to put it into the Excel spreadsheet so it matches up with this, and then we'll sort this in a different order. Then we'll create a chart. How's that? All right, so here's where we left off, and let's just scroll back up here. Let's go to the top. Let's go back to meats, and let's take our lean hogs this time. And here we are for lean hogs. Let's go to historical data. And we don't have to worry about the data range because we're only taking to July 30th. So we'll take August 24th again down to July 30th. We'll do a command C for copy. If you have a Windows system, I believe it's 87 keystrokes followed by something or other. I'm not sure. And let's go paste this into our Excel spreadsheet now. Okay, so I'm just going to put it in the cell right beside the last column here. I'm not going to leave an empty column because I'm going to want to sort this first column, and I'm going to want all the columns across to expand with it. So if I leave a space, I'll only sort this first amount and not the second. So I'm going to stick it in there. There's my command V, and there we go. So if I just highlight this column over here, and we go to home, way at the other end, we have sort ascending or descending. I'll sort oldest to newest. It'll ask me if I want to expand the selection. I'll say yes, and there we go. So now I have July 30th at the top, and I have August 24th at the bottom. Great. This row right here that's in the red and the green, these are my closing prices. And it's nice to see they're in red and green, because red means the price was down, the price was down, the price was up. It's down, it's up, it's down, down, down. So I can see at a glance what direction they went. I want the spread between the two. So what I want to do is I want to take the closing price of live cattle minus the closing price of lean hogs and hit enter, and that's the spread between them. All I have to do is drag that down to the bottom, and there we go. Once I have it to the bottom, I need two numbers. I need an average and I need a standard deviation. Nice and simple. I can just select the average function and highlight the array that I want. Next is standard deviation. Here I'm going to take the population standard deviation because I'm not going to treat this as a sample. I'm going to say this is the population, that's it. And there's my standard deviation. So for this period of time, it had a mean reverting level of 52.52 cents. With a standard deviation of 3.02. But this is just a 20-day period where it appears that volatility was rather low on this contract. I'm going to show you the, I'm not going to walk you through the process of copying and pasting 4 years, because it really, once you start scrolling down that long list, it does take a little while to get to the bottom. I've already done that for you, and we'll see what the mean reverting level and the standard deviation is over that period of time. But this is an important lesson. Depending on the time period that you choose, you may get a slightly different mean reverting level, but you will get sometimes significantly different standard deviations. So when we look at 4 years of data, we'll see that the mean reverting level goes from 52.5 to 54. Not much of a difference, but the standard deviation goes from 3 to 18. So if you're setting up a trade where you're going to trade based on the number of standard deviations away from the mean, you want to experiment with different time periods because it might give you different standard deviations. Now I've tried this with going from 4 years to 5 years to 6, and the standard deviation holds fairly constant at around 18. So I feel that I've got, by taking the 4 years, I'm not underestimating the standard deviation. I'm fairly confident in that. This period of time with low volatility in both contracts, we're getting a standard deviation of 3.02. I would never do a mean reverting trade with volatility that low. It just simply wouldn't interest me. I want nice standard deviations away, so that when I do trade 2 standard deviations out, I feel fairly confident that I am at some extreme point. So that's how you get your data into Excel. Here is our mean. Here's our standard deviation. If we want to draw a chart, all we have to do is just highlight the array that we want. Go to Insert, and we just need a basic line chart. And this is the line chart over, what do we have here? 20 trading days, 1 all the way to 20. And we can see that it doesn't have a lot of variability in here. It's the spread between the 2 contracts is holding very, very close. Now, yeah, well, I was going to mention something about why don't we just buy hogs if the price is too low, and why don't we just short cattle if the price gets too high? Why are we worried about a spread trade? But I think it's worth explaining that when we look at the chart. Let's have a look at what the 4 years of data looks like, and I think I have that on sheet 2. And let me just scroll all the way down to the bottom here, so you can see how long this spreadsheet could become. There we are. So we're all the way to 1173, and I left the first 2 blank. So we have 1,171 observations. That's a very large sample. There's the mean reverting level, 54.408. Very close to the 52.5 we had for that short period of time. But look at the standard deviation, 18.775 versus 3, because we got a lot more variability over this 4-year period. Now that doesn't change very much if I go out to 5 years or 6 years or 10 years. It doesn't change very much, so I feel fairly confident on that standard deviation that it's going to give me some good standard deviation trading ranges. And if I highlight the whole array of spreads, this is the spread between the 2 prices, I get a chart that looks like this. So what I'm going to do in a second, we'll go to another screen. I'm going to draw some lines on here. But right around here where my mouse is going across the screen, that's the mean reverting level. And I think you can see that on the chart, that it seems to always revert to that mean. Whenever it gets to extremes, it seems to come back down to the mean. There's an extreme here, some extremes down here. Up here, these 2 were really big extremes, and I'll tell you what happened to create this, and I'll tell you what happened to create this. But over here we don't have too much. We have normal trading patterns. I think on the tight part of the range, more so than on the on a spread, the spreading apart of the mean reverting level. When I say the spreading apart, above the mean reverting level. So let's go have a look and do some work on that chart. Okay, so here's our chart. Let's draw our mean reverting level in. It's about 54. So there's that's about halfway between 40 and 60. So if I pop up a bit, I'm just going to eyeball this. There's 54. So we'll put our mean reverting level in red across there. And let's go up 1 standard deviation. We're at 54.4 at 18.7. Gives us about 73 somewhere. So there's 70. And we'll just pop up a little bit there. And again, we're just eyeballing this, but there's 1 standard deviation. The second standard deviation would be just a little above 90. So there's 90. And we'll draw the second standard deviation in here. And the third standard deviation, because we do have a peak going up there, would be at around 109. So there's 110. We'll just bring it in a bit. And there's our third standard deviation above. And let's draw our standard deviations below. If this is 54, we'd be somewhere around 36 or 35. So we're halfway between 20 and 30 there. And we'll just go halfway up this way. And we'll use a different color for these lines. There's 1 standard deviation down. And that would put us somewhere around 17 or 18. There's 10 halfway. There'd be about 18 for 2 standard deviations. So let's label these. This is -1 standard deviation away from the mean reverting level. This is -2. And on the upside, we have 1 standard deviation, 2 standard deviations, and 3. So we can see that as the price gets closer together, the price of pork and beef gets closer together, 2 standard deviations seems to be an extreme. a very extreme level that doesn't hold for very long. We don't get to 2 standard deviations, but we do get to 1 standard deviation several times. But when it spreads apart, 1 standard deviation seems to not be as common as -1 standard deviation lately, but historically it was quite common, even 2 standard deviations. So we've got a very significant trade here, a trade here, kind of a signal here, but these two look like positive trades here. So for the last 5 years, it looked like there were 5 distinct trading regions that we were in. Now you have to pay attention to what gets it to these extremes. And this drop right here was fueled by very high corn prices. And you fatten up feeder cattle into live cattle by feeding them corn. And as corn prices go higher and higher, cattle farmers typically will sell their whole or the majority of their herd forward using the futures contracts. It becomes very expensive to fatten up cattle, so they'll send them to slaughter early. So the herd gets reduced very, very quickly, and a lot of beef hits the market very fast. So with a lot of beef hitting the market, the price of beef goes down. So the spread between pork and beef gets very, very thin, and that's what happened here. Well, what happens the season after something like that happens is, well, the herds are too small. So next year you're going to have a shortage of beef because there are not enough cattle to send to slaughter. So typically the season after you'll get a very large spread between pork and cattle, which is what we had here. So if we have a trade that looks like this, we know that next season we're going to have a trade on the other side, simply because of the dynamics of how these animals get fattened up and come to market. And it does take a couple of years to play out. So you had this extreme followed by this extreme, then you had another extreme down here, and then we sort of seem to have found the mean reverting level more commonly in the last couple of years. So the question then becomes, from the time that it hits a point, let's say the 2 standard deviation point, to the time it returns to the mean, how many days is that? Because we need to know, if we're going to use a futures contract, we need to know, well, how far into the future do we want to trade out the contracts? So all we have to do is make a little tick there. Where did it reach the mean reverting level here? And I've left the number of days in here, so we could just count them. This is around 133. Looks like about 157. So this is 24 trading days. At 20 trading days a month roughly. This was one month, 1 week. The second one, if we traded the first time it hit the 2 standard deviation mark, we were here, and by the time it actually hit our mean reverting level, was over here. So this period of time in here, if we count the number of days in there, is roughly about 160 days. So that's about 8 months from the time, if we would have put the trade on the moment it hit a 2 standard deviation distance from the mean, to the time it reverted back to the mean, would have been about 160 days. And down here, if we would have put a trade in and then covered when it hit the mean again, this period of time over here was 60 days. So there isn't any one common theme. It's not like, oh, you know what, they seem to hold pretty much around 60 or 90 days. You have a 24-day period, you have 160 days here, you have 60 days there. The interesting thing, I think, is this. If we look at this one again, by the time it, reached the 1 standard deviation to the time it returned to the mean was a short period of time as well. It seems when the price is squeezed together, as the price of pork and beef comes together, it doesn't take very long for it to correct. But as the price of beef and pork separate, it seems to take longer to correct. So you can work on that depending on, are we reverting back to the mean from negative standard deviations or from positive standard deviation. If it's negative standard deviations, you can look for contracts that are maybe 4 to 6 months out. If it's positive standard deviations, you want to look for contracts that are 6 to 8 months out. So if we observe something like this in, let's say, February, we'd probably want to go all the way to the December contract and trade the December contract. If it reverts to the mean before then, before December, let's say it only takes 90 days to revert to the mean, your December contracts will still pay off. And because these are not options, these are futures contracts, you're not paying any premium for time. Option contracts are free to enter. I say get as much time as you have liquidity. in the contract. So go out as far as you can that maintains some liquidity in the contract. All right, so I've just jumped to a cleaner chart because I want to do some writing on here, and I scribbled too much on the last one. So how do we actually make these trades? Great, we're going to use lean hogs and we're going to use live cattle. But what is the combination of trade that we're doing? Well, let's start down here where the price was only the spread between them was 18 cents between the contract. Well, that's telling me that the price of beef in the supermarket is going to be too low. The price of pork is going to be too high, whichever the case is. But I'm going to look at the price of both and I'm going to say there's not much of a price difference between them. Now that 18 cents here, that's a walking animal walking around. That spread is going to be much wider in the supermarket, so consumers are going to be used to seeing a different spread, but they're going to notice that the spread is very close. They're going to be saying, look, for a little bit more we can get beef. So that's going to drive up the demand of beef. So I know that I'm going to be long live cattle, and because this is a reversion of the mean, if I'm long one, I must be short the other. I'm going to be short HE, which is lean hogs. So there's the trade down here. I'm going to go long LE and short HE at a spread of, well, let's call it 18 cents. And I want to see if I can get back to 54 cents. And per contract, let's say I do one LE and one HE, that's $400 per cents. And what do we have here? We have a 36 cent spread. So my potential on this one here is 14,400 per contract. And we saw that it only took 24 trading days to get that done. So if I were very comfortable with -2 standard deviations, which I am, if I see something that's 2 standard deviations away from a mean reverting level, I think that's a very strong signal. I don't know that I'd be happy with just one contract on either side. I'd probably be looking for anywhere from 5 to 10 on either side. So if I had 5, this turns into 72,000 over 24 trading days. Let's look at what I would do up here. Now I did this trade, and I did it at a spread of about 90 cents. This actually went all the way up here to about 112, 113 cents. So I was down 12 cents per contract, which is about $5,000 per contract. But it got to 2 standard deviations. I put on my trade. As it kept going up, I kept adding. So I ended up in a position where I was down quite significantly. And there was a period of time where I thought, well, I'm wrong on this one. I should try to look at options to minimize my loss at this point and try to at least lock in a smaller loss than what I have. But I let it go. I covered at 1 standard deviation. I didn't wait for it to get back to the 50 cents. I think it covered around 70 cents. But I still did fairly well on this. It ended up being the better part of my year was that one trade when I covered here. But how would I take advantage of this? Well, the spread is too far apart. So I know that consumers standing in the grocery store at the meat counter would say, look at the price of beef, but look at the price of pork. I'm going to pass on beef and I'm going to buy pork. So because the demand was going to head over to pork, I know that I want it to be long HE and I want it to be short LE. That is the trade when the price gets too high. You just have to think of, well, if the spread is too far apart, what are consumers in the store going to do? They're going to look at the price of beef and say, I don't want that. And they're going to look at the price of pork and say, I'll take that instead. Just to give you an example at this point in time, I feed my dog real meat mixed in with his dog food. I always buy him pork or beef depending on where the price is. And I go to Costco and you can buy them in the pre-shrink wrap packages, the big long packages where you take it home and you cut it into pork loins yourself, or if you buy the beef, you buy it in the shrink wrap package. Typically, you'd pay around $18 for one of these, one of the ones with pork, and you typically pay around $24 to $26 for the one of beef. That's typically the range that you would find. Well, during this period of time, every time you went to Costco, this was $5 off. It was always $5 off because there was so much of it. This was actually $13, whereas this was sitting around $45. I'm not kidding. It was something you could buy for $25 was now $45. So I could buy my dog food at $13 or $45. I was buying pork all summer long. So I knew that I wasn't the only one making that decision. I couldn't have been the only one making that decision. So that's because I was always buying that stuff. That's when I recognized, you know what, I think it's time to short cattle and it's time to buy hogs. So short cattle, buy hogs when the spread is too far apart. Buy cattle and short hogs when the spread is too close. And then you just wait for your mean reverting level, and notice it always comes back to that mean reverting level. Now, word of warning. Let's say that you're comfortable with one standard deviation and you get in there. You went through a lot of pain, and very few traders would have stayed in the trade that long. In other words, you would have lost. And you would have been right. At some point in the future, we said, oh, if I had just stayed put, I would have been right. Which is why one of the key skills that you need in the market is patience. You need patience. But it's hard to have patience when the market is moving against you almost on a daily basis. You start questioning yourself. Am I right? Am I wrong? Is this a structural change? Has the mean reverting level changed? Am I changing something that is structurally, or am I trading against something that is structurally changing? Or is this just some pain I got to go through? Well, you never know. I mean, you will never know on that one. You just have to have the fortitude to stick with it. But we can follow some advice that Warren Buffett gave. There are a lot of pitches in this game. A lot of pitches. You don't have to swing at all of them. This is not baseball. It's not 3 strikes and you're out. You can stand there and you can wait for the perfect pitch. So if you look at something like this and you say, okay, well, there are some clear signals here, but I feel a lot comfortable at 2 standard deviations away from a mean. So you might be monitoring 30 or 40 different relationships that you know have mean reverting levels. And every week or so you'll check in on them and you'll look at them and you say, okay, well, which ones look good? And you can rank them from the most attractive to the least attractive. And when something gets 2 standard deviations away from its mean reverting level, that's when you would say, okay, that's the time I'm going to start entering. Other traders would say, well, at 1 standard deviation, I'm going to put on a small trade. Just a small trade. Something that if it moves against me, it's not going to hurt me, but something that I can have patience, because since it won't hurt me, I got the patience to wait it out. And then once it gets to 2 standard deviations, you might increase your position and put a second leg in. So some traders might say, I want my trade here and I'll close here. Others say, I'm willing to build a trade. So at 1 standard deviation, I might add my first leg. A little bit more, I might add another leg. And if it works out, great. If it doesn't, I'll continue to add legs because I feel fairly confident that this mean reverting level is going to come back. And for something like pork and beef, it would be hard to have a structural argument for why the mean reverting level has changed. It would be very difficult to come up with some structural argument because they are such natural substitutes with almost a complete lack of government intervention at the price level. So it would be, like I say, hard to argue something there. Anyways, that is the basic process you go through in setting up a mean reverting trade. The big thing is identifying the substitutes. Once you have that, you can look over history to determine what the mean reverting level is, what the standard deviation happens to be. You can draw your lines, and then you just simply wait until the perfect pitch crosses the plate. That's it for this week.